Hello, everyone. Welcome back to Current Economy and Investment Insights. Today is July 13, 2020. And of course, myself is Ron Janikowski with Channel 4 Imperial Sites. And my co-host is Paul Munichel with Ameriprise Financial. Welcome back, Paul.
Thanks,
and
Ron.
I'm going to let you take it from there.
All right. I'm going to start out the show by recapping the historic rally we've seen in Q2 of the year 2020. So let's begin. After U.S. equity markets transitioned from bull to bear at a record speed at the end of the first quarter, markets registered another record, this time to the upside in quarter number 2 of this year. Investor optimism regarding economic recovery prospects and significant government stimulus drove stocks to recuperate most of the first quarter's downturn. The S&P 500 climbed 20.5% in Q2, its best quarterly result in over 20 years, as domestic stocks experienced the strongest recovery among asset classes. International stocks posted a strong recovery as well, but fell short of U.S. equities as investor confidence appeared weaker among developed market countries. Some emerging markets, meanwhile, have to contend with a later peaking virus outbreak. On the fixed income side, core bonds ended the quarter modestly higher, as continued monetary stimulus kept Treasury yields relatively low. Credit-sensitive bond sectors, such as emerging foreign bonds and high yield, delivered the strongest performance during the quarter as they benefited from investors' risk-on sentiment. While some equity markets have shown a great deal of resilience recovering from this year's downturn, momentum has tapered off over the past month as index levels approach highs and COVID-19 cases in certain states have increased materially amid reopening efforts. Last quarter, we guided that conservative investors should underweight equities given the uncertainties ahead, and that more aggressive investors should stick to their strategic level targets. Heading into the third quarter this year, we continue to believe this is the right approach. While the natural level of diversification is relatively high in more conservative strategies, investors should position for the possibility of continued market volatility in our view. And again, that's just a general recommendation on investing in aggressive and conservative investors. Please don't take any action on your portfolio until you speak with your advisor or trusted representative.
And Ameriprise shared with us this morning's notes that I'm about to read to you. Global equities are off to a strong start this week as investors continue to shrug off increasing coronavirus cases. S&P 500 futures are higher by nearly 1%, Paul.
Yeah, it's nice to see that rally continuing. We'll take it while we can get it. But as I just kind of warned, we do expect volatility to come back into the market sometime either this quarter or next.
The yield on the 10-year Treasury is edging higher to near 0.65% ahead of the start of the corporate earnings season. So that should be interesting to see what happens from here forward.
Yep, and if Treasuries are starting to edge higher, who knows how much higher they'll go. Might want to check your mortgage rates and the rates currently to potentially refi if it makes sense for you.
Do it now. Yeah. Stocks in Asia closed higher after the PBOC said it sees the economic growth normalizing in China during the second part of 2020. I'm going to leave it at that. And the U.S. chips for investors, make note, Maker Analog Devices said it has agreed to acquire Maxim is what I should have said, Integrated Products, Maxim Integrated Products in an all-stock deal. That should be an interesting merge, buyout.
Yeah, big deal.
See what happens. I have some year-to-date information that I'm going to share with you, Paul, and if you have some comments to make. The year-to-date for S&P 500 is a minus 0.38%. Dow Jones, a minus 7.44%. NASDAQ, interesting, plus 19.01% all year to date.
Yeah, a lot of those NASDAQ type, growth type stocks have performed very well this year amongst this coronavirus breakout. They've performed well, as you reported, up 19% by the index. That's dramatic. That's great.
And I'll add to that, be careful. Looks like a bubble to me.
Potentially, who knows? Wait
You never
and
know.
see. Right.
Yeah. Okay, that's for current economy, and stay with us. We are going to be switching to your money, and Paula's got some interesting topic, importance of emergency funding. So you should have emergency funding set aside, and I'm sure that's what he's going to talk about, how to do this, and some guidelines on it. Stay with us. We'll be right back. Hello, everyone. Thank you for staying with us. We are back with your money, and Paul is going to be talking about the importance of emergency funding. Paul, I'm going to let you take it from there.
Thanks, Ron. It's obvious that no one could have predicted with any certainty how quickly the COVID-19 pandemic would change the lives of so many people around the world. Fear of infection, stay-at-home orders, and a rallying cry to help flatten the curve have drastically changed how people behave in their daily lives. In the face of so much uncertainty, the need to have an emergency fund, and again, that's a tool that can help your family manage the financial fallout in the case of a job loss or any other unwelcome impact, has come to forefront. What constitutes an emergency fund and why it is so important to have one, particularly in times like this? Let's go over a few points why. 1, financial solvency matters. Financial experts generally encourage you to set aside 3 to 6 months worth of living expenses in an emergency fund. Without it, you're at the risk of losing what you've worked hard to achieve if life were to throw you a curveball. A stash of funds to help you meet your monthly obligations, keep your credit report clean, and preserve your way of life. Point number 2, put your priorities in order. An emergency fund deserves to be at the top of your list of financial priorities. Emergency reserves are designed to provide safety net to prevent financial disaster. Saving for your retirement comes next to help your financial future. Even better, if you can save for both priorities at the same time, that's the best. If you're currently saving for your future, consider allocating a portion of monthly contributions to go towards an emergency fund. Once your emergency fund is funded at a satisfactory level and you continue to regularly contribute to a retirement account, you can start setting money aside for discretionary items such as new furniture, a vacation, or even maybe a vehicle upgrade. Next is to set a goal. Determine how much you need to stay afloat for an extended period of time if there were any income disruption. At a minimum, how much would you need to have on hand to pay your bills and buy groceries each month if paychecks stopped coming in? Then simply multiply that value by 6, and that's your 6 months worth of your emergency fund. Next, start where you can. If you don't have a large chunk of money available to establish your emergency fund right now, don't let it prevent you from starting an account and working towards your target. Any amount is a step in the right direction, even if it's $50 a month. If you don't need your stimulus check to cover immediate cash expenses, maybe use that to start to supplement your emergency fund. If your tax refund is another potential source of cash, maybe use that to start growing your emergency fund. And always revisit your current budget to see where you can trim expenses and put more money into savings. The next point, create and stick to your guidelines. Your emergency fund should be reserved for times of financial crisis. It's not an account to pay for life's little extras, however tempting it may be to dip into. With guidelines in place, you can avoid dipping into these funds unless absolutely necessary. And last but not least, keep emergency funds within a safe reach. When uncertainty strikes, you may need money in a hurry. For this reason, emergency savings should be held in cash or easy to access investments like a money market fund. You may also want to open a dedicated interest-bearing savings account, potentially in a bank, separate from your other accounts, to keep your emergency funds at a safe distance if you're one who may be tempted to spend it. And as always, we recommend working with a knowledgeable advisor to help you set up this emergency fund, to help you get on target towards your retirement, and if you are retired, to help you manage those retirement funds while in your retirement period. As always, if you're not working with someone or if you're looking for a second opinion, feel free to give me a call directly at 708-226-3412.
Paul, that's pretty good advice. And you know what's really important in all this financial reserve that we were talking about, you have to be dedicated to taking out a small portion of your income and setting it aside. It's not going to happen any other way.
No, we talked about that today. Like, don't feel like you have to do it all at once. Even if $20 a month, $10 a month, something is better than nothing. Put it in an account and build it up for that emergency reserve, and then don't be tempted to spend it on a vacation or a new car. It's not for that. This is strictly for emergencies.
Exactly. You know, sometimes these things are easy to talk about, but you really have to sit down, plan it, and make it realistic. Otherwise, it's just not going to be there in the future when you do really need it.
Yep, exactly. We need to plan for the unexpected. No one expected COVID to hit as hard as it did.
Right.
And unfortunately, at some point down the road, something else is going to happen. I don't know what it is. No one does, but something's going to happen. And we need to start preparing now for that next unknown.
Excellent point. Okay, well, for Paul Munico from Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you good investment day.